If you're ready to take your finances to the next level, you're in the right place. It's time to take control of your future, starting now, and we're doing it live. Hi, we're the Stidhams, and our goal is to help you get self-directed. It's the tax-free income that will shape your legacy. It's wealth, time, and the freedom you deserve. What you're about to learn will enable you to make confident and strategic moves. It means gaining complete control to invest in what you want when you want. We've helped thousands of people just like you. And if they can do it, you can too. So we hope you're ready, because it's about time that your money started working for you. And we're so excited that you chose us to show you how.
Starting right now.
I messed that up because that's not supposed to be in there. So restart. Just kidding. We're just going to start it all over again.
Don't mind us. We're just going to play the intro again.
We're just going to welcome. Welcome everyone. And thank you so much for joining us. We know that time is the most valuable asset, and we honor the time that you're spending here with us. Tonight, we're going to answer the question that people keep asking. And Donnell says, what do you say? This deserves a full, detailed response, more than what I can give right now with the graphics and visuals to explain. And that's what we're going to do tonight.
Yeah, there's a few consistent questions that I've been receiving around secure compound interest account, how money grows in it. And so my thought was just to kind of step through what growth inside of an account over the first 3 years would look like. And I thought we'd use the first 3 recent years. So 2021, 2022, and the start of 2023, and just kind of talk through that. We can go into further detail if we need to, but I'll probably hold it there. And then I wanted to address one other thing. And it's been a consistent question that I've been getting lately related to HELOCs. First position versus second position, and which one should we get? Like, hey, I've got this mortgage with this great interest rate, and me and my significant other have been going back and forth around, should we get a first position HELOC or a second position? So I want to just talk through that. I probably won't go into a detailed example on that, because I think that deserves its own explanation with pictures and all those kind of things. So we'll get there. But I do want to just highlight and talk through those two subjects. So
yeah,
that's my thought.
And we thought this is a way that instead of having a walkthrough or a storyline to teach tonight, that it would be also valuable for those who come in and they just have questions. You guys have had questions, and sometimes we've had to put those off because I wanted to get through the subject. But tonight is your night. So this is a great time to jump in the comments and ask those questions. We're also paying attention to our text messages. So if you guys have already been texting with us, a lot of people have been, and we love that, of course. We love hearing your questions while you're going through the worksheets, or your questions while you're going through the videos, and being able to address those in real time. And there's a bunch of people who've asked questions inside the Facebook group as well. So that's also a great resource and a great way to connect with others and see how other people are using it. Or we just had one recently. I haven't had a chance to watch the video that he put in there, but he kind of posted a challenge to what we talk about. There's another video out there that was challenging what we talk about. And so he was saying, hey, you guys want to respond to this? Because I found this, and so now I have questions. So all of that, we love that, because the point of what we're doing here is to get educated so that we can make those confident, educated decisions. What a strategy is or isn't, it really depends on how it fits inside of your machine. Right. And that's what we hope that you get out of this is there may be strategies that people swear by, and they go, no, you got to do, like velocity banking, for instance. You got to do it this way. This is how you do it. But when we get in there and we see people's numbers and we go, you can't do velocity banking with no cash flow. So you have to do the debt snowball method until you get cash flow. And there's different strategies that apply to different people. You want to say something?
No, I think you're spot on. And it's there are 5 strategies that we have used to unlock our journey towards our WTF moment. And it's a self-directed IRA or 401k, meaning taking advantage of our previous employers' retirement accounts to be able to put us in a position to be able to invest in our retirement accounts.
Oh, I think something happened. Am I frozen too? Welcome to the next stop on your journey from. Why did it do that? I wasn't
I
hitting
just work here.
anything.
I just work here. But anyway, my point was
Maybe it's
self-directed
trying to tell us
IRA.
something.
It might be self-directed IRA and 401k is kind of what we use to kind of kick the door open, because it was us being able to leverage our previous employer's plan. Literally, what I ended up doing was borrowing against my self-directed 401k, so I didn't have to go to my employer, didn't have to ask. It was my own, and how I did it, I set the terms, I created the structure, the whole nine, and I still paid myself back, but it was something that I owned, not it was something that I was allowed to do, or something that I was able to do because it was my own. And then in addition, taking that and using velocity banking, using infinite banking to be able to get us in a much better, I'll call it credit worthiness position, which allowed us to transition our mortgage into a first position HELOC, all with a goal. The goal was not to pay off debt. The goal was not to pay off our home in 5 to 7 years. I think is how most people kind of position a first position HELOC. The goal was to free up cash flow. The goal was to put ourselves in a position to where we could take this cash flow and actually start to actually go after that WTF moment, meaning putting that money into a vehicle that was actually going to work for us, putting our money to work, having our money create employees, creating a system, a holistic, secure system that allowed for this money to grow uninterrupted. And these are the 5 strategies, 5 steps that we use. So I think I guess concerns me when there's some debate around what it is we actually do. There's nothing to debate. Now, we can talk about how, we can talk about what better fits you, but to tell me that this doesn't work, it's working. It's literally working. And they all fit, they all talk. That doesn't mean you shouldn't contribute to your company's 401k or IRA. I'm just going to share with you, hey, your company's 401k, IRA, 403b, TSP, government 457 plan may not be producing what you thought it would. And
Right.
these aren't my words, right? These are the
Yeah.
words of Jack Bogle and literal Vanguard leadership who says, "Hey, this is riddled with fees. It's not me."
Well,
And so,
there's
go ahead.
proof that this doesn't work. It's not
That's my
just us
point.
saying it.
That's my point. This is not me trying to wave a magic wand and do some bait and switch or some trick to make you think a certain way. That is not it. This is just education. The whole objective is to pull the curtain back and let's actually look at things. Because I'll say it and I'll say it and I'll say it. Banks, financial institutions, and life insurance companies do not care about you. So the best thing you can do, the best thing we can do is leverage them the way they have been leveraging us. That's all. This is about leverage.
Yeah, and if you don't know what you don't know, then you have no idea when something is staring you in the face. You have no idea when something has gone completely over your head. And if you would have known that information, then you would have made different decisions in that moment. That's really what this comes down to. It's having a bigger vision. What you're going to talk about tonight reminds me of something like this equation that I was just doing this week. It was okay, well, I did not see things going the way that they are going, right? And I didn't foresee us needing help with the business end of things this quickly. However, when the time came and I went, okay, if I don't do this now, I'm we're going to be I'm going to be super stressed out, and that's not going to be helpful for anybody, right? So do we invest and do we get some help now? And a lot of people would not do that. They would say absolutely not. They would have a hard time letting that money go, right? Going, technically I could probably find a way to do it myself because we're not there yet. However, what I know now is that if we're going to keep growing and we're going to be able to serve more people, right? and give them the attention that they all deserve. And I hope you guys, give that feedback. We get reviews and whatnot, but what we hope is that you guys feel like we're not unreachable. We're not just here for the live stream, and we're not just here for the views, that we're really here to connect and build a community and grow. Everybody, you guys are all here with us. You're coming with us. We're building a family here, right? And I love that. And I love to hear people's stories. But if I'm so busy that I have to give short answers, and I'm so busy that we have to curb our time as to who we can be available for, that wasn't our mission. That's not why we jumped out here. So I had to do this equation of, is it worth it to put in now, right, to have the benefit later? Or do I keep struggling knowing that if I don't make this decision right now, I could actually limit myself in the future and make things actually worse for me? So it's the same concept, and how you do one thing is how you do everything, right? Understanding the decisions and how they impact your future and how they impact your goals matters greatly. And when you do understand where your leverage is, then all you're seeing is where is leverage. You see the next piece of leverage ahead of you. And so that's what I hope when we're going through this, that we don't get like we don't get messy in the weeds here on figures or percentages or some of the math that, for me, I just completely check out. It's this hard for me. We came up with another way of delivering this, but we just weren't ready to present it tonight. So I'm excited for you guys to see that. But what I hope is that what you're looking at is leverage, one, and also you have your goal in mind, right? What's your goal?
Absolutely.
Yeah. Okay. So anything else you want to add before we jump in?
So
Yeah.
just quick setup. So again, today is to kind of address a couple questions. And they're
Great.
independent questions, actually. So we're going to spend a little bit of time deep diving. And I laugh because you mentioned math. There's going to be some math today.
Yeah.
And I don't think there's any pretty slides that my wife put together. I think this is all handwritten by me. So I apologize ahead of time, but there will be math, but I won't go too far, too in depth. It's really just, hey, what's up, coach? Uh, the main objective, though, is just to answer a few questions, consistent questions that I've been getting. Again, one around a secure compound interest account. The example we went through last week was related to a young lady who's a client of mine, current client of mine, who started with me when she was 32. She's 35 now. She's in the third year of her secure compound interest account, and something special happens at the third year. And so the thought process was to step through year 1, 2, and 3 to kind of help you understand what happens at year 3. And there's a little bit of a twist here that I know I talked about last time, but it can be easily overlooked. So I just wanted to go into that detail to just help everyone understand this could be you too. And provide clarity on, again, a consistent question that I receive is how. How is it that this secure compound interest account can grow this way and my whole life policy or my IUL or my 401k can't? How is it that this secure compound interest account can produce this type of income, but these other vehicles can't? Like, sounds like a scam. Like, I want to just address or give a little bit more credence to how, explaining the how. And then the second one is, I've been talking with a lot of people about HELOCs, whether it's the example around using a 7% HELOC to address a 4% mortgage, and whether you should or shouldn't get one or the other. Or there's been a debate around, because I've talked a lot about first position and second position HELOCs. I haven't really gone in detail around how a second position HELOC will help you or how it could hurt you. So I wanted to just kind of, I'll call it, set the stage for kind of how I talk through second position HELOCs, to kind of just plant another seed of there are other options out there. And so I'm not here to debate first versus second. It's just kind of walk you through an example based off a question I've consistently received. Should we get a first position HELOC or a second position? So those are the two things that I mainly wanted to address today.
Okay.
All right.
Before we jump in, I just want to address this real quick. Greg, yes, you have to add me to your sheet so I can see it, and then I can help you fix whatever's in there. and then just text us, and then we'll be able, when you do that, or uh, let me know in the Facebook group or something. I think you're in there for sure. So that is how I would be able to help you. And Tamiko, I think this is a great time to tell you to get the worksheet. That's a great place to get all your numbers together. I think it's been powerful for people to see all of their numbers together. And sometimes they're like, whoa, I had not seen that before. And sometimes it's a humbling experience. Sometimes people are actually kind of excited. Like, I didn't, okay, well, it's not that bad, right? Once they get their strategy together. So get the sheet. All right, so we've just got some, what federal or state governing agency oversees an MPI plan? Maybe you can address that while you're going into it.
So MPI is a strategy. Very similar to infinite banking is a strategy. Both are strategies applied to life insurance based products. There's many types of life insurance based products. There are whole life policies, variable life policies, index universal life policies, universal life policies. There's a lot. There's term life policies. And the governing body over life insurance policies are the life insurance companies who have those life insurance policies. MPI though is just a strategy. And it's a strategy that you cannot apply. You can't walk to any life insurance company and go get this strategy applied to your life insurance policy. We work with a select number of life insurance companies, and they are all A+ rated life insurance companies, been around since well before the Great Depression. Matter of fact, one of them specifically helped bail out the banks in 2008. So these are not, I'll call it mom and pop agencies where the concern is in 10, 15 years from now, will they even be around? And if you, again, if you know much about how life insurance companies like to make their money, they're all about very low risk. So life insurance companies, the reason they are so successful is because the objective is not to put their clients, put their money, put their resources at risk. So it's all about consistent, low risk growth. And so I think governing body, I think usually what comes behind that question is, hey, the money in my bank is FDIC insured. How's the money in this life insurance product safe? And what people usually miss when they say FDIC insured, banks, your money at the bank is covered by an insurance agency, federal, but it's an insurance agency. And this is no different. Your money inside of whatever life insurance company we're using to do your MPI plan is covered by that life insurance company, to put it short.
Okay, all right. We have some questions about the worksheet. So before we jump in, we will just, get the comment off so people can see it. This is where you get it. Right here. It's I guess it's not playing. Oh yeah, there we go. Okay, so it's selfdirected.info/live, and you'll find some graphics that look like this. You'll find the information about the group. Why am I pointing in the wrong direction? Okay, here we go. It's all right here. That's it. So go grab the worksheet, everyone who doesn't have it yet, and give me your feedback. I'm not an Excel wizard, so we've learned that that's been proven with all the feedback that we've been getting. So we've upgraded it, we've improved it, we've made it even better, and there's a ChatGPT prompt in there too. So you can after you've gotten everything together, then you can take all of that information, throw it into ChatGPT, and it will help you strategize your velocity banking schedule. How dope is that? And then you just take that, paste it right back into the worksheet, and get to cutting out the debt. So that's exciting. All right, so you ready to jump in?
Yeah, let's do it. I think the half will be fine for now.
Okay, that's good.
Right.
Yep.
So let's see here. So again, the main objective for today is just to kind of talk through a couple of questions, and I'll focus on the first one, which is a secure compound interest account. How is it able to do what I seem to think, or how I even seem to say or show with the calculator as to what is it capable of doing? How? And I wanted to use or piggyback off of the example that we used last week with the young client that I had, who 32, started her account. She's in her third year. So again, as much as you've heard me talk about a secure compound interest account, at year three, something special happens. At year three, you're able to use all of the leverage from year one, throw that into year three. And so now you have more money working for you, and a portion of it, you didn't even have to do anything to contribute. It's coming from the life insurance company. So we can call it a match. We can call it the premium finance strategy. There's a lot of different terms for it, but ultimately it's just a participating loan being added into your policy and allowing you to be able to use the leverage. And so, but how do we get there? Like, where does this even come about? And so I wanted to just highlight this. One of the biggest pieces around how a secure compound interest account is able to produce the income that it's able to produce compared to everything you know to be true. Meaning the other pieces of or other vehicles that we are used to investing our money in, majority of them are all tied to the stock market. So on, I guess that's on your left-hand side is the stock market performance. A lot of wins, a lot of losses, a lot of ups, a lot of downs. But when you, I guess I should have done that earlier. But when you look at the performance, one moment. When you look at the performance over time, hopefully everything that you do inside the market is moving in an upward direction. So therefore your money at least is growing, although you've had some, some pitfalls, some downward points in the market where you had to recover from, but hopefully your money is at least moving in a positive direction. Well, what's the difference between this and a secure compound interest account? Well, it's all about the risk. If you can reduce and or eliminate the risk, you can create uninterrupted compound interest which, yes, it does not grow fast. This is not a train that moves very quickly, but when it starts to move, it really takes off. And notice we can still end in the same place. It's just one, you slept well at night knowing that your money was working for you. And the other, you spent a lot of time watching the market, wondering whether or not you would have enough at the end of whatever that downward spiral was to be able to achieve income. And to look at that mathematically, though, there is a clear difference between those two pictures. And I know this is probably hard to read, but it ends up being just simply a mathematical equation. One is a risk adverse equation. One includes risk. And the key is if you can eliminate this part, if you can reduce the risk inside of this equation, you can produce uninterrupted compound interest. And the variables in this equation are very similar. But again, there's one difference, and that difference is right here. That difference is if you can eliminate the risk, if you can reduce the up and down performance, you can produce uninterrupted compound interest with no issue. And each one of these variables has a name, because you hear me talk about the first one all the time. It starts with first, pay yourself first. The best thing you can do is take care of you first. Before you pay a bill, before you pay your mortgage, pay yourself first. Take a percentage of your income. I usually start with 10%. But if you're in the position to do so, 20% would be much better. 30% would be amazing. But the first step is to pay yourself first. And once you pay yourself first, the question is, where do you put it? Well, once you pay yourself first, you have to put that money, or you have to start when. So you pay yourself first today, meaning pay yourself first right now, not later, not after the mortgage has been paid off, not after the kids have been put through college. Pay yourself first, starting today, and you have to secure your money. You have to secure your money. Put your money in a place where, regardless of what happens with the market, regardless of who's president, regardless of what happens in your life, your money is okay. And then once you've paid yourself first today and placed it in a place where it's secure, you compound it. You teach your money how to make its own money. And as your money starts to make its own money, then you spend that. Instead of you spending, you get paid today, you spend the money you get paid and you keep what's left over. You get paid today, you pay yourself first, put it in a secure location, compound that money, and then you spend that. You spend the money that your money is making. And then ultimately, you exponentially grow your money. How is that? Well, the best way to do that is arbitrage. using someone else's money to be able to exponentially grow yours. So you pay yourself first, starting today, somewhere secure, compound your money, and then ultimately exponentially grow your money using OPM. And if you're able to do that, you can beat that traditional performance of the stock market. And that's ultimately what we want to talk about. Is most of our traditional investments are tied to the market. And because it's tied to the market, that includes risk. You remove the risk, you're able to produce uninterrupted compound interest. So what is it about MPI? What is it about a secure compound interest account that allows you to produce uninterrupted compound interest? So that's what we want to dig into. So to do that, if you were on the live a few days ago, you might remember this slide. And this slide kind of talked about, again, a young lady who is contributing a $10,000 lump sum, $5,000 in year one, $5,000 in year two, and $1,000 a month. And sweetheart, if you slide over to the calculator real quick, we can just take a look at what $10,000 lump sum plus $1,000 a month actually looks like. So again, 32 years old. And I ran this out to 55 because her objective was to retire early. So 32 years old till age 55, putting away a lump sum of 10,000. That's 5,000 year one, 5,000 in year two, and $1,000 a month. At 32 years old, I call that going all in. And she by age 55, she would be able to produce, she would be a millionaire ultimately. A millionaire by age 55 with income of 111,000 tax-free for the rest of her life. And even though she's only put in 286,000. Now she has a 403B, I think is what it was. And she has the option to put that same dollar amount in a 403B. And notice, I would say $1 million in cash value inside of a product like this compared to 913,000 inside of an IRA, 401k, or 403B. I call that similar, but the issue is not net worth. The issue is how much income does that produce? We're talking 111,000 tax-free compared to 36,000 taxable. So this is her policy. I got a call at year three. And as I mentioned, something special happens at year three. So here we are at year three. I got a call at year three saying, hey, and just so we're clear, this is the end of year two, starting year three. So this dollar amount is not up. This dollar amount is not 46,000 because she hasn't completely contributed her $1,000 a month yet at year three. So we're at the start of year three. The piece that's important is this. She forgot that at year three, there's an additional $17,000 of leverage that's added on top of her account, meaning the growth from year one and the growth of year two, because she's funded her policy consecutively for the first 2 years. At year three, when she inputs her first $1,000 at the first month of year three, there's additional leverage added. That additional leverage added in, per the calculator is 17,000. Well, her actual amount of leverage that was added at year three is 18,005, meaning the calculator under promises and her actual performance ended up being 18,005 of leverage being added right now at the start of her year three. But here's the other part of that. What happened the last 2 years? In 2021, the market did great. In 2022, everyone lost about $3 trillion in their retirement, meaning the market crashed. And this is a product that is tied to the S&P 500, meaning the growth inside of this, the call option inside of this product is tied to the performance of the S&P 500. So if the market crashed, that means the S&P 500 did not, the S&P 500 also lost. And so, and ultimately what that means is we lost 24%, 24% inside of the S&P 500. So inside of a product like this, what does that mean? Well, because of the 0% floor, maybe we don't lose 24%, but you also don't make money. So what that means is in year one, 2021, she made money. In year two, she did not. She just held where she was. And so, and at the start of year three, now we kick in the leverage. And the piece that I want to connect you to is this. Made money in year one, made nothing in year two, and still beat what the average of this calculator states. Meaning, if she continues on this path, this number at age 55 won't be 111,000. there's potential. It could be closer to 150,000, 160,000. It would definitely be something greater than what she has, even with a down market. Can those of us who have IRAs, 401ks, 403bs, Robinhood accounts, anything tied to the market, can you say the same thing? Now I get it. You have the potential for the home run, but you also have the potential for the strikeout. Whereas here, even with the negative market performance, there's no strikeout. But the question that I get is how? So
Yeah,
I just want, go ahead.
Michael says, thanks for this. It's what I came to the live to learn about.
No
So
problem.
thank you for that, Michael. We need that feedback.
No problem. So the thing I want to highlight here, I'm sorry, you can go back over to the, sorry, producer. You can go back over to the other side.
Take me to the vibe board.
All right. So I want to highlight here. So here's what I'm going to do. Let's set the stage. You're putting away $1,000 a month, $10,000 as a lump sum, which means $5,000 in year one, $5,000 in year two. It's 2021. And the reason I'm showing this visual is there are two things that are going to happen in your account. There's your contributions that are going in, and then there's this match, this RELOC, this participating loan, this premium finance strategy. It has a lot of names. But the moral of the story is there's also going to be a second dollar amount going into your account. So again, you have your contributions, $5,000 plus $1,000 a month in year one. And then at some point, not year one, there's no match in year one. So in year one, it's just you. But the cool part, the piece I want you to understand is this bucket that holds these $2 amounts is protected. It's protected by the 0% floor. What that means is there's a contractual guarantee, not a Donnell guarantee, not even an MPI guarantee. Any IUL, well, I guess I can't say any. Most IULs have this same guarantee. And that guarantee is this. There is a contractual guarantee that you can't lose the money that you're putting into the IUL. And that contractual guarantee carries over to any growth. So as the money grows inside of this IUL, there is a contractual guarantee that you can't lose that. So the purpose of this visual here is just to understand there are $2 amounts at some point. But where we're starting now, we're starting in year one. There's only $1 amount. So let's talk about year one. Let's see here. Yeah, I think that's about good.
Ooh, look at your handwriting. It's so fancy tonight.
You know how many times I have to write this?
Man, I can tell there is effort in those digits,
Man,
y'all.
whatever. Okay, so
I'm being serious.
I know. So at year one, so we're at year one. This is 2021. Again, 2021. Well, yeah. Let me go over here before I do that. I'm sorry. Let's come here. So what we're talking about is an IUL, and the IUL's growth as it relates to the call option is tied. So for an index universal life insurance policy, this is any of them. We use the S&P 500. Now, do you have to use the S&P 500 crediting? You don't. There are many other index funds that you can use. Why do we use the S&P 500? Mainly because if you look at the data over time, the S&P 500 is the best. So in an MPI plan, we use the S&P 500 crediting. This is the performance since 1997. You can average this on your own, but if you were to do so, it was right around 7.2%. Now, the years that I want to, and I'll make it even bigger. Want to make sure you see it. What happened? Come on. I guess that's as large as I can make it. What happened in 2021? 2021, we got the full crediting, 10%. If we were using, and the cost of the leverage is also showed. Deferred interest if owed, meaning the match. The match costs us 4% if there's match involved, but if there's not, doesn't apply. But in 2021, we had a crediting of 10%. In 2022, it was 0. So what I want to do is walk you through 2021 and 2022 inside of this product. So if you're on this live and you have an IUL, if you're on this live and you have an MPI plan and you receive that MPI plan somewhere around 2021, this is you. Because I've had several clients who are approaching their third year and they're approaching their third year and not fully understanding what's happening inside of their policy. So I just want to walk you through it. So again, here we are in year one. It's 2021. Make that a little bit bigger. It's 2021. And in 2021, they're putting in $2 amounts, a $5,000 lump sum in year one, plus $1,000 a month. So at the end of year one, the total contribution would have been $17,000. So $17,000 is going into this bucket. There are fees. I am not about to calculate the fees, but there are fees, and I'm noting them here. I'll make this a little bit bigger too. But this bucket is protected by the 0% floor. So what that means is when I put this 17,000 in this bucket, it's untouched. There's nothing going to happen to the money that's been contributed minus the fees. There are fees in the bucket. I want to make sure that's clear. But this bucket is also going to grow your money around 5%. And so all this number is here is what's 5% of this number? 5% of this number is $850. So what happens is when your 17,000 goes into the bucket, protected by the 0% floor, meaning untouched, it's going to grow your money somewhere around 5%. What allows that money to grow? Well, it's because this bucket is not tied to the stock market. This bucket is tied to AAA rated bonds. So based off bond performance, that average growth is somewhere between 3 and 7%. So all I'm doing is taking the average. Halfway between 3 and 7 is 5. 5% of 17,000 is 850. So once we take this 850, we're going to buy a one-time call option in the S&P 500. Okay, so what does that mean? Well, when we take that $850 and buy this call option, what we're saying is someone way smarter than me, an actuary, not Donnell. Donnell is not buying call options. An actuary who works for the life insurance company, who's been doing this for ages, is going to buy the one-time call option in the S&P 500 index point to point. So meaning 365 days. So high level example, take this $850,000 and $850 and buy a one-time call option, basically stating, I believe the S&P 500 index is going to close somewhere around here. Well, the truth is it closed higher than that. And for this example, let's just say it closed somewhere around 4,600. So I said it was going to close at 4,000. It actually closed at 4,600. So meaning it made 15%. But the growth on my money did not make 15%. The growth on my money, my $850 bought a call option, and the growth on my money, meaning the growth on the 17,000 that's in the bucket, made an additional 10%. So even though the S&P 500 made 15, I only made 10. Why? I only made 10 because there's a cap on my performance. I only made 10 because to keep my policy, keep my growth secure, what we don't want is unlimited, meaning we don't want unlimited growth because it also means we can bottom out, meaning there's no 0% floor. So what we want is a 0% floor. We want to be protected by market volatility. But that comes with a caveat though. And the caveat is, okay, the max you can make on that call option then is the ceiling of 10%. And that number can vary. Right now it's 10%. And so even though we made 15, the max I can make on the total amount that I have inside the general fund is 10%. Okay, when I make that 10%, what is that math? Well, okay. That math equates to this. 10% of this dollar amount is $1,700. And then my original $850 that I used to buy the call option, I get back. So $1,700 plus $850 is what now goes back into the bucket. So it goes from here to here. So now at the end of year one, I have my 17,000, which is protected, and I just made 1,700 plus the original 850 that I used to buy the call option goes back into the bucket. All of that, once it hits the bucket, becomes brand new principal, which means it can't be lost, which means it's protected. If this was the performance of your 401k and you actually achieved the 15%, you did better than me. So I made less than you inside of your traditional retirement account, hands down. And I'm okay with that. So let's go into year 2. And this is just kind of a recap of year 1 that's sitting in the bucket. So at year 2, it's 2022 now. It's 2022. It's currently sitting in the bucket is the 17,000 from year 1, the 1,700 that I made, the 850 from the growth in the bucket, so a total of 19,550 minus fees. Again, I didn't calculate the fees and I'm not. But the bottom line is what's in this bucket is the new principal, and that new principal is protected by the 0% floor. And in 2022, I take another 5,000 and another 12,000, $1,000 a month, and I'm going to put it in this bucket. And when I do that, this dollar amount plus this dollar amount is going to grow somewhere around 5%. That equates to 1828. So what am I going to do with that 5%? Again, I'm not touching this dollar amount. I'm not touching that dollar amount. It's all sitting in the bucket, protected by the 0% floor. I'm going to take this 1828 and I'm going to buy another call option. Again, no different than year 1. There's no leverage. There's nothing else special happening in this account. I'm just doing the exact same thing I did year 1 with a different dollar amount. So I'm going to take this 1828 and buy another call option in the S&P 500 index. All right. But what happened in 2022? In 2022, when we went to go buy this call option, the market wasn't doing too hot. We said the call option, the index fund is going to close somewhere around 4,800. Well, what happened was everyone lost 24%. If you remember a few weeks ago, $3 trillion in our retirement account was lost. Everybody lost money in 2022. Which means I said the actuary said the call option, the index fund was going to close around 4,800. It ended up somewhere around 3648.
Bruh.
But what happened to me? What happened inside of this MPI strategy? Because of the 0% floor, I did not experience any of this 24%. Again, because of the 0% floor, I can't experience anything beyond nothing. Whereas everyone else lost 24% inside of their account. Remember last year when everyone was in my face talking about how much better they did in year 1 than me, but in year 2, they lost 24% and I didn't lose anything. Well, I didn't lose anything isn't true. I took 1828, 5% of my total, and bought this call option. Because the market crashed, I lost the 1828. So the growth on the money that I had is what I lost. I didn't lose anything else in that bucket. All of the money that was made in year 1 when we had such a great year is still there. But I did lose the gain from year 2 when I went and bought that call option. So what that ultimately means is, hold on. What that ultimately means is none of this went in here. I didn't get anything. I did not make any money in 2022. But here comes 2023. Something special happens in 2023. In 2023, this is the 17,000 from year 1. This is the growth from that 17,000 in year 1. This is the 17,000 from year 2. This is the growth from that 17,000 in year 2. There wasn't any. Well, starting in year 3, something special happens. I'm going to put in another 12,000. I'm not putting in any more lump sum. So it's not 17,000 that I'm putting in year 3. I'm only putting in the 12,000 that I committed to. 5,000 year 1, 5,000 year 2, no more lump sum in year 3. So I'm only doing $1,000 a month, 12,000 total. So when 12,000 goes into this bucket, I now have an additional 12,000 in the bucket protected by the 0% floor. But as I mentioned, something special happens at year 3. At year 3, the life insurance company comes along and says this: hey, because you fulfilled your obligation, because you funded your policy consecutively in year 1 and year 2, everything from year 1, that 17,000 you made, the 1,700 on the growth, the 850 that you also made minus the fees equates to $18,500. All of that gets to be pulled into year 3. And again, the reason I share this is because what did the calculator say though? The calculator said, hey, on average, it should be about 17,000. But in actuality, even with a down market, you did not make any money in year 2. So even with a down market, you did better in year 3 than what the average said. But what happened in your retirement account? What happened in your 401k or IRA? What's the recovery period required to recoup the 24% that was lost in 2022? I don't have that problem. Why? Because we have uninterrupted, secure compound interest. Uninterrupted. Why? Because this money is sitting in a bucket protected by the 0% floor that the life insurance company says we guarantee you can't lose the money in the bucket. If your 401k, I got a 401k too. If my 401k had a 0% floor on it, that means in 2022, I wouldn't have lost 24%. I would have stayed where I was in 2022, and I would have taken off from that point in 2023. How much more powerful would a 401k be with the 0% floor? How much more powerful would your IRA be with the 0% floor?
How many more families would be okay if they had this protection in 2008?
My mom retired this year. And how much more secure would her retirement be had she not lost 24% in 2022? Like, come on.
Cindy has a great question, if you don't mind.
Let's do it.
All right. She says, does the actuary ever look at the long-term market forecast and if they think it will be a down year by a put option instead of a call option? It's a great question.
So that's absolutely a strategy that I think if this was a traditional, I'll call it index trading stance, then yes. But the only thing we do inside of an IUL, and I don't care what IUL we're talking about or where you get the IUL from, the only thing that happens inside of an IUL is option. That's it. And again, why I really can't say. I think that's just how the structure of the IUL itself. There are other, I'll call it universal life or variable universal life life insurance products that you can also have. But as far as this, an index universal life insurance policy is solely based off that call option. Now, the best thing that you can do is you can choose whether you want it capped or uncapped. But again, uncapped implies risk. Uncapped means you get all that performance of the greatness of the market, but you also absorb all of that negative as well. And again, I would rather have consistent base hits and a few home runs versus wins and losses, home run, strikeout, because the math just maths better. Hopefully that answered.
Yeah.
And so in year 3, go ahead.
No, Cindy, if you have follow-up questions, please put them in the chat. If anybody has questions, please put them in the chat. Go ahead with
So year 3. So we're in 2023. Here's your 17,000 from year 1 and the growth from year 1. Here's the 17,000 from year 2 and the no growth from year 2. The 12,000 that we just put in plus the 18,500 that we just added from the life insurance company that you didn't have to qualify for. The most you had to do was fill out paperwork in order for us to be able to do it. I have several clients that are going through this right now, and they're receiving a RELOC form or they're receiving a jump application, which means they just have to fill out their personal information that says, yes, I want this 18,500 to go into my secure compound interest account. But guess what? You still have a choice whether you need to do that or not. And I'll give you my personal position on this. We are at a point, same, because we're in our year 3 as well. We have a similar dollar amount that we're able to dump inside of our policy. Well, the easiest thing to do is we can also use that money to open up other policies. It's still leverage that's available to us. This is about leverage. This is about using someone else's money to help build wealth. So I'm going to use a portion of that someone else's money to open up more IULs. So you have flexibility to do what you want to do, because this is it's about getting self-directed. It's about taking control. You have the ability to decide how much of this 18.5 goes in, if any. And then again, everything in this bucket is protected. So what's now going to happen is we're going to take 5% of the dollar amount in this bucket and buy a one-time call option. We are in the midst of year 3. Year 3 hasn't happened yet. We are right in the middle of it. So assuming, because the market's been doing great so far, assuming a great performance inside the market, now we're talking about another 10% growth on top of the money that's in that bucket. Uninterrupted, secure, compound interest. And again, I go back to this document here. The difference between traditional investment plans that we also called IRAs and 401ks and secure compound interest accounts, which are basically compound interest accounts, the difference between these two is risk. If you can remove the risk from this equation, you can achieve uninterrupted secure compound interest. So sweetheart, if you don't mind going back over to the calculator and we can button this part up.
Well, I think Carl has a question while you're there.
Yeah, let's do it.
He says, are the call options based on my anniversaries or the company's fiscal or calendar years?
That's a great question. So let's say you're putting in $1,000 a month, like this example. That call option from, let's say you put in let's say you start at the beginning of the year, January. So from January 1 till December 31st, that first $1,000, there's a call option done on that. And then in February 1st to January 31st, there's a call option on that dollar amount. So there's dollar cost averaging as well. So it's from your anniversary date to your anniversary date. Good question.
Okay, where do you want to go? Oh, the calculator.
Yep.
That's
And I
right,
just,
okay.
again, just to button this up. My point in sharing this is this. This calculator is meant to underpromise and overdeliver. So if you're upset about how, I'll call it, amazing these numbers look, my point to you is this: they're only going to get better. Because again, at year 3, this calculator stated we're taking 17,000 of leverage and adding it to year 3. But in truth, in actual performance, it was more like 18.5, which means over time, this 111,000 that is being accumulated inside this account will be something greater than that. This $1 million of cash value that has been achieved by age 55 is actually greater than that. This death benefit, again, you purchased $731,000 in life insurance, but if something were to happen to you by age 55, we're talking about $3.2 million passed on to your beneficiaries. All of these numbers will actually be better than that. So any questions, and again, I only went through the first 3 years. We can step through the next 15, but it's the same performance. It's, hey, at year 3, we borrow from year 1. At year 4, we borrow from year 1. At year 5, we borrow years 1 and 2. At year 7, we borrow years 1, 2, and 3. It's the same performance. And the key is, the piece that I want you to remember is your money is protected. The growth on your money is protected. So regardless of what happens with the call option, the risk is the growth that happened inside of your account that's used to buy the call option. That's the risk. There's no risk on your money sitting in the general fund. All right. So any questions as it relates to the first question on how does the SCIA grow over the first few years?
Oh, here's our girl. You know, Lolo's got those good questions too. What circumstances would have to come about that would make the insurance company increase or lower the cap? And how often does this happen, especially lowering the cap?
Yep. So I have had my policy for 3.5, almost 4 years now. I'm in year 3. I'm in the RELOC point right now. And when I started, the cap was 10.5, 11%. The cap today is 10%. I doubt you will hear anyone else say this in an industry like this, but we would actually prefer interest rates to continue to go up. Because what happens when interest rates go up? Well, as interest rates, the cap is based off prime, and whatever other tools the life insurance company used to determine. But the bottom line is the cap is based off where the interest rates are. So as interest rates go up, what that means is the cap will also continue to increase. And that's whether we're talking about an IUL or whole life policy. It relates to all cash value life insurance products. As interest rates increase, that cap, that ceiling will increase. Well, here's why that's pretty awesome in a product like this. There's also a cap on the participating loan. So as of right now, if you're leveraging money from the life insurance company, that additional 18.5 that we pulled into the policy, there's a cost to borrow that money. That cost is 4%. So we're borrowing 18.5 at 4%. We're making on average 7%. So that leaves a spread. If it costs us 4 and we make 7, it leaves a spread of 3. Well, the actual performance is actually 10%. So the actual spread is 6. Well, as interest rates increase and that ceiling of 10% increases, so does the cost to borrow. But there is a limit on what that cost to borrow is, the high point that cost to borrow could be. And that high point is 6% contractually, meaning the participating loan cannot be higher than 6%. Well, if we've reached the maximum amount, we've reached the ceiling of the participating loan at 6%, and interest rates are continuing to go up, which means the ceiling on the call option is continuously going up. We would much rather prefer a 14% cap on the call option, because now a 14% cap on the call option and a 6% cap on the participating loan, 6 and 14, that 8% spread is much better than that 3 to 6% spread. So my point is, I guess around your question around, can the life insurance company arbitrarily change it? I guess the life insurance company can honestly do what they want, but the way history has projected, if you look through the history of the performance of a product like this and how interest rates have been increasing, they've been increased very, very slightly, very minimally over the last, 20 years. And there's a cap on how much they can charge for the loan. And so in a product like this, we would actually prefer interest rates continuing to rise, because that means the spread is better, which means you're growing, the amount of money growing inside of your account is actually better as well. A lot of words.
Out of words. Every time you talk about the buckets, all I think about is there's a hole in my bucket, dear Liza.
I'm surprised
Every
we haven't
time.
done that already.
Yeah, I think it's like copywritten, or I would have played it, because every time you're like, oh, I'll just talk about the buckets. And I'm like, well,
Hit the button.
fix it, dear.
I'm
Every
surprised
single
you have
time.
not already done that.
Is anybody else thinking about that song when he starts talking about the buckets? I'm not alone.
Just
No,
you.
I'm not alone.
Just you.
No, they're
So
going to
again,
come.
that was the first question. Any other questions before we jump to the second question? Because the second question is related to HELOC, so a totally separate topic. But it's a consistent question that I'm receiving, and we can always go back to the calculator. We can always go back to MPI if we want, but I do want to, just from a time perspective, I do want to jump into the second question and address it. So if you pull up the half of the
Well, real quick, because I just want to honor.
honor. I love honor.
I want to honor that 30% of our viewers are on the TV. We are increasing with TV viewers, and I love that, because you could probably see things better. You can see Donnell's fancy handwriting HD.
That's
I love
scary.
that for you all. But
I was a straight A student in Catholic school, by the way. Straight A, with the exception of one class, penmanship, CD.
there was
C's and D's.
a penmanship class where you went?
Yes. Again, Catholic
Wow,
school. So there's
that's
all sorts of
fancy.
classes that you don't
Well,
normally have in other schools.
look at you now. Um, so what we know is that people who are watching on the TV, though, they can't jump in the chat to ask questions. So you can get your phone out right now. Why do I like pointing disease or something? Okay, you can just get your phone out and take a picture of this. This will take you to where you can chat with us. You just hit the button, boop, send us a text message if you have a question, and that makes it a whole lot easier. Or you can just pull up the live stream on your phone, turn the volume down, and then you can jump in the chat that way too. So that's how you can do it. So I think this is a great opportunity moving forward because we do have a whole lot of HELOC questions
Yep.
that we get texted all the time.
Yep.
And this is something where even today, Kenya and her husband, I know they said that they're watching. They're one of many couples who are in the same predicament, which I find fascinating that you think you're alone having these conversations with your spouse, right? You think that it's just you guys who are doing the math and having these conversations and trying to go, well, which way do we go? But there's a lot of people who either they're working together or they're not working together, and one is not does not believe that these strategies are going to work, or one is not on board, and so therefore it makes almost makes it impossible for the other to move forward when they're the ones trying to learn about this. We were in that same kind of situation when Donnell first came home and said, hey, I got this new thing we're going to do, and I thought it sounded crazy. I never heard of it before, and I was like, why can't we just focus on making more money? And because that to me sounds like it, why can't we just focus there? Like, I that is familiar to me. I know that that will fix any problem, that will help us in the future, right? And he was like, no, I'm not saying that that's not true, but watch what this could do. And if I would have resisted, we would be in a completely different place right now, regardless of there's not an amount of money that we could have made that would have caught up with, realistically, that would have caught up with the growth and the impact that this has not just had on us, but for generations to come, for sure. And time, right? You got to get started right now for this to be able to work. It can't happen at the end. So kudos to all the couples who are out there and the partners who are trusting, who are just kind of following along, like, okay, whatever you said this thing was, right? These strategies, and there's five. They may not work for everybody. They may not be everybody's jam, but this is how we did it, and this is why we are out here sharing this with you. We do not believe in the gatekeeping. We want more people to have financial freedom, and this is how we did it. So I just wanted to say that welcome all the couples who are watching, and they're kind of at odds was one of the phrases used today, at odds. And when I asked, well, what are you guys discussing? And they said first position versus second position. And so you've heard it too. And so that we thought we would just spend some time tonight going over that.
So give me the half of the vibe board, and I'll set the stage.
We do have a question. Hold on. Sorry, before you get into it, Carl wants to know: are you or your organization an insurance broker, and if so, can you mention a few?
So I am just a life insurance agent. I have the ability to provide life insurance. I am not a tax attorney. I am not a financial advisor. I don't have a Series 7 or 6 anything. I'm a retirement consultant. You can call me a retirement planner, but ultimately I'm a guy who figured out some strategies and I'm sharing those strategies. Now, as a licensed life insurance provider, I am a fiduciary. It's part of the license. So I do follow the fiduciary standard, meaning I have no problem sending you where you need to go to be able to achieve your goal if I can't help you. I am not captured by anybody's company. I have my own. It's called self-directed retirement plans. And under self-directed retirement plans, there's a lot of things that we can do. Again, there's retirement strategies, whether we're talking IRAs, 401ks, or annuities. There are life insurance-based strategies in the form of a secure compound interest account. Everything else is just a concept. Infinite banking, it's a concept. MPI specifically is a concept. Velocity banking, it's a concept. And so, am I a broker? I am not. Do I work with brokers? I work with several, actually. I have the ability to work with any. Um, there's probably maybe 15. And as it relates to life insurance companies, that's a little bit more defined because not every life insurance company is even allowed to provide a secure compound interest account in the form of premium financing. So I'd say if there's a specific company that you're wanting to know if I work with, I say reach out. Let's jump on the calendar and we can talk through that. It's probably the easiest thing to do. Okay.
Yep. Okay. But most importantly, we're not like out here to sell insurance. This is not a,
No, this is
that's not
about
what this
income.
is.
This is
And
about
it's
income.
strategy.
It's about strategy and income. That's right.
And
All right.
that's part of what makes us different is that we don't care of what we won't give it to you unless it helps you in your strategy, but you have to know your goal. So,
That's
all
good.
right. So what scene did you want to
Just a
the,
five board,
the
half board.
vibe board? Okay. All right.
So again, that second question is HELOC. First or second, which one? And just to kind of set the stage a little bit, this is an actual situation that I just talked through today. I'm going to massage the numbers a little bit so that it fits. But the truth is, this is an actual situation. So before you kind of jump into the comments and you go, they don't even offer that anymore. That's not true. So kind of set the stage a little bit. I guess I can I don't have to put it on the board yet. To set the stage, we're talking about a mortgage there's $150,000 owed on the mortgage. The mortgage is at what 2.9%. So a mortgage at 2.9%. The goal is to potentially get a first position HELOC in place of that mortgage, first position HELOC at 8%. Or would it make more sense to get a second position HELOC at 10%? So I've got a mortgage at 2.9 and I owe 150,000 on it. The home is worth 600,000. Mortgage owed is 150. House is worth 600,000. So let's get into it.
All right.
So again, I'm not going to go into a whole lot of detail here, but I'm just going to want to kind of walk you through what's going on. So again, the home is worth 600,000. The mortgage on that home is 150. That $150,000 mortgage is a $1,200 a month payment at 2.9%. And the question is, should I do a first position HELOC or a second? And this might get a little controversial, but I'm going to choose that 10% over that 8%. And here's why. I'm a logical person. At 2.9%, why would you want to give up a 2.9% interest rate? If you use this same velocity banking thought process and use a second position, you can still hit your goal. But remember, the question is, what is the goal? If the goal is to be able to produce income, if the goal is to be able to pay off your home, like depending on what your goal is, you can still use a second position HELOC to complete that strategy. So again, the home is worth 600,000. 150,000 is what's owed. It's $1,200 a month mortgage, 2.9%. The second position HELOC is 10.02%. Here's my thought. My thought is we're going to take out a second position HELOC for $100,000. So that's $100,000 at 10.2%. $100,000 is a second position HELOC at 10.2%. What are we going to do with that $100,000? We're going to take all 100 and dump it into the mortgage. The mortgage owed is 150. So when you take this $100,000 and dump it at 10.2%, when you take this 100,000 and dump it into this mortgage, what happens? Well, the balance, if you do a principal only payment, the balance left on that mortgage is now 50 grand, right? And that's $50,000 at 2.9%. Make this a little bit smaller. This might look a little bit weird though. What I'm saying is, when you take this $100,000, dump it onto this $150,000 mortgage, and you have $50,000 left over, 2.9%, your payment can now become $400 a month. How? How's that even possible? If the original payment was $1,200, how is it possible that I can go from a $1,200 a month payment on a mortgage down to $400? How is that even possible? Well, it's this little thing called a recast. So the fact that you have a 2.9% interest rate on your mortgage means you shouldn't want to give that up, because there's many things that you can do with that 2.9% interest rate. So if you dump $100,000 from that HELOC onto the mortgage, it now eliminates $100,000, drops that balance down to 50. If you recast that $50,000 mortgage, based off that 2.9% interest rate. So what does recast mean? Recast means you're going to have them recast that $50,000 across 30 years. So you're starting the clock over. At $150,000, I'm pretty confident this client was well ahead on his mortgage. At $150,000, he had been paying on this mortgage a long time. He was probably 14, 15, 16, 17 years in. So when he recasts this $50,000, it's now going to spread that $50,000 over 30 years. But when you do that, it drops the payment. And what's the cost to recast? Maybe $100, maybe $2. So it costs nothing to recast. So when you dump a lump sum like $100,000 onto this mortgage, you then recast that $50,000, and that changes that $1,200 payment, the original $1,200 payment, down to $400. So now you've just increased your cash flow by $800, right? Okay. But we still got this $100,000. So now we have a mortgage at $50,000 for $400, and we've got a second position HELOC for $100,000 at 10.2%. I did not pull out one calculator, so I don't know what 10%, what an interest only payment on $100,000 at 10% would be. I have no idea, because the piece that I want this audience to receive is not the interest rate. It's the strategy. I'm going to assume a 10% interest rate will cost you $1,000 a month. Is it $1,000? I don't know, nor do I care. The piece that I want you to get is when you put $100,000 from that HELOC onto your mortgage and drop that balance on that mortgage down to 50, spread that 50 over 30 years, you just saved $800 a month in cash flow. Your cash flow just went up by $800. So now, sweetheart, if you go back to the board. So now, when you now have $100,000 that you do owe $1,000 a month. So you went from paying $1,200 a month to now paying $1,400. That sounds outrageous. You're telling me I'm going to go from $1,200 to now paying $1,400? I can't do that. Well, you can if you're doing velocity banking. And there's an assumption that has to be made here. You're not even thinking about a HELOC if you don't have cash flow. So the assumption is you have cash flow. So the key is to just simply do velocity banking on this $100,000. Continue paying the minimum on your mortgage, but do velocity banking on your $100,000. And I'm going to make an assumption. Let's say you make $5,000 a month and your expenses are $3,000. Again, I am just making up numbers. My point is, if you make $5,000 a month and your expenses are $3,000, you have cash flow of $2,000. Take that cash flow, do velocity banking, put all of your income into the HELOC. All $5,000 goes here. Pay bills from this HELOC, which means you're going to drop the balance down from $100,000 down to $95,000, but then you're going to pay bills. So you're going to take this cash flow of $2,000 and do velocity banking on this $100,000. When you do that, in 2 years, if it's cash flow of $2,000 a month, in 2 years, the equity that would be sitting on that HELOC would be $48,000. Can we agree that in 2 years, the balance, the remaining balance on this mortgage would be something less than $50,000? Would it be 48? Probably with amortized $50,000, it might be $49,900. So it may not be $48,000, but here is the point. In 2 years, you would have put $2,000 a month onto that HELOC. The new balance on that HELOC would be $48,000. So in 2 years, you're going to now take that $48,000 and pay off that $50,000. You're going to take the $48,000 that is sitting on that HELOC from doing velocity banking after only paying the minimum. You're going to take this $48,000 and pay off that $50,000. So you're going to pay off the mortgage using that remaining amount. So what ends up happening? So what ends up happening is at the end of those 2 years, you now have a HELOC that has probably, and again, I'm guessing, a HELOC with about $98,000 on it. So when it's all said and done, the mortgage is zero at the end of 2 years, And now all you have left is this home equity line of credit. If your cash flow was $2,000, then it just went up by $400. So now your cash flow is $2,400. What can you do in 2 years with that $2,400? Well, in 2 years, what we're going to do is we're going to jump right into a secure compound interest account. We're going to use velocity banking on that $98,000 HELOC. We have no mortgage. And so we're going to now start paying ourselves first, since we didn't do it to begin with, and I intentionally did not. But 2 years, I think, is a decent time frame that if it takes you two years to get yourself out of this situation, do it. But at the end of those 2 years, you're going to take that cash flow and go all in on a secure compound interest account. My point is this. On a mortgage of $150,000. Oh, sorry. On a mortgage of $150,000. I've been listening to Donnell, and we've got a great interest rate of 2.9%. We've got a decent monthly payment of $1,200. Donnell's been saying, man, you can take this first position HELOC, put yourself in a position to pay this off, and use that equity to then put yourself in a much better position. But should I replace my mortgage with an 8% HELOC, or is there a better strategy that might require a debt tool with a larger interest rate? It might. I'm not here to tell you what the right answer is, but what I can tell you is you have many options, and this is one of those options. And as I always say, this example deserves a lot more detail and a lot more explanation. So what I do plan on doing is putting together a much larger, detailed example of how to use a second position HELOC, but you better believe it's going to look just like this. It's going to be very simple. You take your second position HELOC, you get whatever you can get. Maybe you can't get 100,000. Let's say you would have gotten 50. Take $50,000, dump it on that mortgage, recast the mortgage. And you can recast, well, your bank may say you can only recast every so often. Maybe it's every year, every 2 years, or the lump sum that you dump in has to be a certain size in order to recast. Okay, then you have to fit in whatever that criteria is. But my point is this. There is absolutely a way you can use a second position strategy to be able to pay off your home faster than even a first position strategy, mainly because of the structure. And the moral of the story around all of this is none of it matters if you don't have cash flow. You have to have cash flow. If you have cash flow, you absolutely can put yourself in a position where you can achieve whatever that goal is. I didn't even bring up the goal. I just jumped right into let's pay off this house. And I did it with a 10% second position home equity line of credit on a 2.9% mortgage. Let's do it. Yep, let's do it. Recast is not refinance. Recast, and again, you have to talk to your bank because I'm going to assume banks can do what they want. So there may be criteria around your recast, meaning they won't recast anything above or below a $50,000 lump sum dump in on your mortgage. So that means get $50,001. Like whatever the criteria is, make sure you meet it. But you're right. Recast is not a refinance, which is why, and again, Google it. Just type into the search bar recast. What you'll find is usually the cost of recast is a couple $100 because it's an administrative move. What they're doing is they're taking your amortization schedule that used to be this 150, whatever's remaining of that original mortgage from that point till the end of the 30-year period, and they're just running a brand new 30-year amortized schedule based off the same interest rate for that new balance. That's all that's happening here. And now think about it. If you don't do a process like this and you just recast your mortgage, okay, that's a $400 payment that you're paying forever, or 30 years, not forever. That's a $400 payment that you would be paying for 30 years. Maybe that's okay. Maybe just the difference between the $800, the $1,200 you were paying and the $400 on the recast is sufficient enough for you. And for the comments that are coming, around, well, if I've got cash flow of $2,000, why don't I just dump $2,000 a month into my mortgage? You can do that. It just does not make sense to me, because if you do that, how else can you use that $2,000 of cash flow when it's sitting in your mortgage? You can't. It's about strategy. It's about structure. What's the goal? The goal is to pay the home off in a certain period, or the goal is to be able to put yourself in a position so you have equity or an asset available to you to be able to leverage to do other things. It's about leverage. The first example was about leverage, meaning if you're leveraging other people's money, you can produce uninterrupted secure compound interest. If you use leverage, if you're leveraging the bank's money to pay down your mortgage, or you leverage the bank's money to put you in a better financial position to be able to pay bills off faster, you're leveraging the bank's money to build a secure compound interest account. It's about leverage. If you're putting all of your extra money onto your mortgage, what are you leveraging? Nothing. But I'll adjust those comments when they come. I'm sure they're coming.
Well, turn to your neighbor and say leverage. This is, I couldn't resist. Okay, we have more comments here. Let's see. Alandio wants to know, will this illustration be affected if the HELOC balloons after a certain amount of time?
Okay, HELOCs have variable interest rates. And you should understand, this is where you got to talk to your bank. You need to when you enter, I'm going to call it an interview. You should not walk into a bank to go get a HELOC. You should be walking into a bank or a credit union to interview the bank to understand how the HELOCs work. So you're going to ask them questions on, is the interest rate variable? How is the interest rate calculated? What is the frequency of that growth? Is it can it jump 1-2% in a, like, is it prime plus 1 or 2%? Is it based off LIBOR? Like, you want to ask all of those questions to understand. Can it balloon over a certain amount of time? The answer is yes. But notice the time frame here. It's 10% at year one. Let's say it's 11.5% by year two. Do I care? Because I just paid off my mortgage. And okay, I do have to pay back that pay down that HELOC, but because it's an open-ended product and because I have cash flow, it's about the cash flow. Because I have cash flow, I put all of my effort into this HELOC, and okay, maybe instead of jumping right into my secure compound interest account at the end of year two, maybe I take a year and I allow that 2,400 of cash flow to break down or beat down that HELOC, meaning 2,400 times 12. All right, 2 times 12 is 24, 4 times 12 is 48, so 24, so that's 28.8. So if you end up putting in 28.8 of room onto that HELOC in year one, then maybe at the end of year three, you take 10,000 and start a secure compound interest account. So maybe it pushed your timeline out a little bit, but because of the hike in interest rate, you don't want to put yourself in an over leveraged position. I respect and understand that. So then you make those types of adjustments. Or how about this? You refinance into a lower interest rate. How would a bank look at you is that if after 2 years, not only did you pay your house off, you're making ground on that HELOC, and you went back to that bank and said, hey, do you offer any other products? So my mortgage is paid off. And that bank goes, sorry, we can't help you. Fine. Go across the street to another bank and show them your credit worthiness. Show them the fact that you have a mortgage with no balance on it. And yeah, you've got this HELOC that's sitting with, let's call it 90 grand on it. Then refi, go get the promo rate. Go get the promo rate for 18 months. And then you rate stack. And that's another one. We'll do videos on rate stacking too, because there's also a way to take this, jump into a brand new HELOC with an 18-month 0%. I know it's not 0%, 18-month 4% rate. And then before you hit that 18th month, maybe around the 12th month, you start shopping around for another HELOC. And right as that intro rate starts to end, you jump right back into another HELOC and you do this all again. So you can rate stack. Like, there are many options here, not just I am a slave to whatever the bank tells me. And focus less on the interest rate and more on the strategy and cash flow. If you don't have cash flow, we shouldn't be having this discussion.
Sir, you are answering questions that we're not asking. You're skipping the line. Okay. All right. We've got April, who
I
says,
feel like I'm
does
yelling too. Am I yelling?
well, you're passionate. We know the difference. It's
I
like
apologize if I'm
it's
yelling. Because,
like back in
man,
the
if I was
day,
sitting
all
at
of
home and
the
some dude was yelling in my ear, man,
you know
my
what
bad.
we don't get this kind of passion. Back in the day, we had like the videos, music videos with the rain, and they would be like, reaching out and pulling it in, and like
Ah,
it was the rain, and it was all the passion. And now we have Donnell helping you get self-directed. All you gotta do is throw in a girl in there on occasion, and we've got a hit.
but what's the dude's name on MSNBC? He get all sweaty, and I feel like I'm doing that. So let me calm my ass down. My bad.
Yeah,
My
it's
bad.
all good. I think they love it. They've got some questions here. So back to
Let's do it.
April. Back to you, April. Does
Back to you,
velocity
Bob.
banking still work with higher interest credit cards? Banks are tightening up on offering PLOCs. So can you still do this with a high interest credit card?
Um, Short answer is yes. Can you? And again, this is the question is, can you do this? Yes, you can. Does it make sense? I can argue both ways. If your only option is to use a high interest credit card, if you have the cash flow and you know how to work your high interest credit card, meaning I'm going to take on debt between the end of the statement date, no, end of the due date up until the statement date. So I'm going to attack debt between there and there. And then right before the statement date, I'm going to make sure it's zero. And then when the statement registers, I'm not getting hit with all of that interest from all of that work that I did. Like, so if you manage that high interest credit card through this velocity banking process, it could do amazing things for you. Um, when we started Velocity Banking, we did have the luxury of having a lower interest credit card. I want to say it was like 9%. And we used a 9% lower interest credit card to pay off the 17, 22, and the 29% credit cards. So that's why using a credit card to pay off a credit card makes sense. But would it have made sense to take a 22% credit card to pay off a 7% credit card? It just doesn't make sense. But let's say that 22% credit card is the one that you're able to link to your checking account and do overdraft protection and pay all your bills and pay your mortgage. That 22% credit card has more flexibility. Then okay, if you're going to use that credit card, know the risk, know the impact of doing so. That means the interest is going to be larger. So you need to make sure that the balance on that credit card is as low as possible. So when you're sweeping money from your checking account into the credit card, you have to be very diligent and understand what that looks like. So, yes, you can. Does it make sense? Not really. But sometimes that's all you got, especially if banks are tightening up on personal lines of credit. I get it. I get
That's
it.
that's right. I mean, that's the point of knowing where your leverage is, because
Yeah.
sometimes you may have to do something that's a little uncomfortable that may not make sense, and that's where we get into the weeds in the comments with people all the time. They're like, "How does this make sense?" Somebody said, "Is $300,000 house mortgage even reasonable?" Well, it depends on where you live, because
Short answer is
in
yes.
but in some
Yes, it
places,
is.
the short answer is no. You know what I
Right.
mean? Location
Right.
does matter.
Location
So
matters.
but that's not the point. We pick numbers that try to make sense, that make the math easy. Why? I should have a soundbite by now, because I freaking hate math, right? And I don't like to get caught up in the numbers. It's about
It's
the
the
strategy.
strategy.
Yeah, right.
It's about the
And it doesn't.
strategy and it being structured properly to work effectively. It's about the this example around whether you should use a first position HELOC or a second position. I have not checked one number. Let's be
Yeah.
clear. I have no idea if the numbers even make sense. They make sense in my head. That's all that matters. And what I'm trying to walk you through is the strategy of taking a second position HELOC, using a higher interest rate HELOC to pay off your mortgage timely, and still have a debt tool that is open ended for you to be able to do velocity banking and do other things.
Yeah. Well, Carl's ready to go to the calculator, so we're
Let's
gonna
do it.
go
Let's do it.
there.
Let's do it.
Let me
I am
find
done.
it.
Those were the two questions that I wanted to answer today. So yes, absolutely. We can jump into the calculator. If you have other questions around either one of those examples while I'm in the calculator, you know me, I'm long-winded as hell. I can address those too.
We actually do have a couple other questions, and I think this is good to go since we're going to the calculator.
Yes,
It
ma'am.
was from Samantha
Hey,
today.
Samantha.
and I think she said she was able to tune in tonight too. And her question earlier was around she's got her student loans, it's just pretty much her only debt. And she was wanting to, like, she's trying to strategize of what year she would leverage her policy to pay off her student loan debt. And I thought this is really important because in our minds, we're programmed to like get rid of this debt. But the problem is that sometimes we're not doing the math on the money that could be growing versus the interest being paid on debt. So this is where a lot of people get themselves in trouble later with velocity banking in particular, is that they're so focused. You know, they've got Dave Ramsey out there. He's in the ring with the fist too, like yelling at people, right? But he's yelling at people like how dumb people are because they have debt and you've got to get rid of it. Well, who wants to feel stupid? So they're like, of course, yeah, debt does sound like a not a good thing. I'm going to get rid of it. Not going to make it part of my world anymore. Getting rid of it. So they put it as a number one priority, and then they get to the end of the debt and they're like, okay, Dave, now I can't work anymore, I've got to retire, or I got laid off and I'm kind of aging out of my career. Like there's a lot of different scenarios, right? And then he's like, but do you have debt? And you're like, no, I did, paid it all off. He's like, good job. You're like, but
And
now
that's
how
what
do
you
I
win.
survive? How do I
This is
survive,
what you
Dave?
win when you're debt free,
Yeah, how do I
right?
survive, Dave? Ramsey, help me. And he's like, oh, no, you should have been doing something a long time ago. Like, are you stupid? And people are like, what are you talking about? I did everything you said to do. Literally. I made all the things the priorities that you said, Dave Ramsey. Now I'm just now that's just is just what I have. Well, this is the same thing that people the same fate
Sentiment.
that people get when they sit with their financial advisor too. You worked this whole career, you were working weekends, you were missing your kids, whatever the case was, and you were a careered individual providing for your family and investing in your future. And you're like, that's it, this is a wrap. Get the cake, get the streamers, come on, let's get all of this party started, my retirement, like I'm ready to get out of here. And then they're like, but really,
Dun, 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 dun.
you are going to make maybe a fraction of what you were making now. So let's talk about downsizing. Let's talk about minimalist lifestyle. Let's Marie Kondo your budget and get rid of anything that doesn't bring you joy. You know what doesn't bring people joy? Learning that they're going to be broke and not have enough. Like, can we get rid of that? Can we talk about that? Because that doesn't sit in your garage. That's not in a box somewhere taking up space. Like this is looming everywhere. It's in the air. You're breathing.
Well, and with everything
Poverty.
going on with student loans right now, this is a hot topic.
Yeah.
And it's a consistent question that I've received related to, hey, should I focus on my student loans or should I do something different? And everyone is different. But let me make some assumptions. Let me make the assumption that the student loan debt is a weight that feels heavy to you. It's not that the weight is heavy, it's that the weight feels heavy. Why? We've been conditioned to believe that debt is not our friend. But let me also make this assumption that student loan debt, let me put a number on it, 50 grand. And that student loan debt, the cost of that student loan is maybe $50 a month. The first question that I have is, can you handle $50 a month? So if you never paid off this loan, like meaning if you died with this loan, could you handle the $50 a month? Or would it make more sense to take your cash flow that might be $1,000, $500,000, $1,500 a month and dump that cash flow into this student loan so that you can pay off that student loan debt quickly? Well, I'm a math guy. Let's talk through what the math looks like. If you're taking your cash flow and that cash flow of round numbers, $1,000 a month, $12,000 a year, $50,000 in debt, 12,000 times 4 is 48. It takes 4 years to pay off that student loan debt. In 4 years, what could that $1,000 have done in a secure compound interest account? Let's do that math. And yes, you're debt free in 4 years, 5 years, but you lost 5 years of compounding in a secure compound interest account. could you have still paid that $50 a month for those same 5 years and allowed that $1,000 a month to continue to compound in a secure compound interest account that's building a vehicle for you that you can actually retire off? And if you do that secure compound interest account right, still pay off that student loan at some point. And that's kind of, so to me, it's less about the debt. Is the debt really the weight, or is it that you feel that the debt is weighing on you because we've been conditioned to believe that? Let's set the weight to the side. Let's set the student loan to the side and let's do some math. What does the math say? And 9 times out of 10, the math would say pay yourself first. 9 times out of 10, it would be, if you want to pay a little bit extra on that student loan, okay. But I am okay with the fact that I will never pay this student loan off so that I could secure income for the rest of my life. I don't know.
Yeah,
what
that's
else to say
it.
to that.
And also, we're going to bring this up because this is why we get into the weeds and why we like start keyboard banging with people in the comment section, right? Like
I'm a
these
math
are,
guy. So I look at the numbers because I'm a math guy. But as a fiduciary, it is my responsibility to put you first. That's my fiduciary responsibility. And in order for me to put you first, I might have to look at the math.
well, what I was trying to say, El Muchacho, which by the way is super fun to say. Just wanted to point that out.
Oh, muchacho.
El Muchacho.
Oh,
The reason why we say that the math isn't important for the what we're talking about is just because we're talking about strategy, and that's the part that we usually end up like
Right.
in the
We're
comment
on a
sections.
live talking about strategy. When we sit down, we have to be specific about the
Yeah,
math. Like
I
we
just
have
want
to
to clear
jump
that up.
into detail. Yeah. But on this live, there's no point in me talking about $32.42 compared to $32 because it's about the strategy. If you can understand the strategy, the number does not matter because once you get the strategy, it's over. And then
Yeah,
once you get the proper structure to apply the strategy, what can they tell you? They can't stop you. So it's about understanding the strategy. And again, I get into the numbers where I need to get into the numbers. And all I'm saying here is it's not necessary to understand the strategy. That's all.
yeah, and it makes it
It's a good
easier when you're
comment, though.
not so focused on the math
What I
to,
appreciate about the comment, though, the clarity, I think the clarity is necessary
yeah,
because I think he brings up a great point for a fiduciary not to be concerned about the numbers. That is odd. That is absolutely odd. And what I am referencing is in a situation like this where we are just walking through examples to help you understand the strategy, it is not required. But you better believe when you are sitting with me, it is absolutely about the bottom line because I'm focused on income. I'm not focused on velocity banking. I'm not focused on infinite banking. I'm focused on income. And in order to be focused on income, it is absolutely about what those numbers say. What does the math say? Let's be specific. So
and
that's my
everybody's
point.
math is different, which is
Absolutely.
why we can't be tied to a strategy for
Absolutely.
everyone,
Yeah,
right?
it's a good point.
Yeah.
Thank you, Mushasho.
Yes, and your name is fun to say. I don't know where you got all that from, but that was fun. And if anybody who has a challenging comment or question, please feel free because I think that we need to understand how we're coming off and to
Yeah, I
or how
agree.
people are receiving us too. So we're not offended if people push back. What's hard is that what we keep trying to say is focus on the strategy, and here's why. We've given so many examples of where somebody would go, oh, that cost 200. Like last stream we talked about a husband and a wife who were they had different ideas of how money should be spent, right? And in his mind, he was going, why would we pay $230 extra if we don't have to? If you end the sentence there, then yeah, anybody
Why
would
would
be
you?
like,
Right. I agree.
exactly, why would you? But when you finish the sentence and you say, why would we pay $230,000 to gain 1.5 million? Now, that changes something, right? And that's essentially what we're saying is if we got caught up in the number when we're focusing on the strategy, then you would miss the whole rest of the sentence. And that's what was lost there, is that he could not see this part because he was getting stuck there and he could not move forward. And he would be 60, 70 years old, thinking back to that day when he decided, no, I am not going to spend an extra $230, and he's going to be kicking himself, right? But thankfully, his wife was going, can we just continue the sentence? Can we finish the sentence out? And can we talk to somebody about it? And when they did, then he was even like, okay, hold on a second. I didn't hear the rest of that sentence. And darling, you would not have if you would have just changed the channel, right? Tuned out, said, well, I don't know what these people talking about. They are crazy.
10%
And that
versus
lady, she hates math
2.9? Are you
anyway.
kidding me?
Right. So why does this work? It works because these are things that should have been taught to us a long time ago. Because it's not hard. There are systems that are in place that we can leverage. Turn to your neighbor and say leverage. There are things that we can do, and we can leverage some of these systems that don't have to involve us sitting in a casino and betting on red, right? Like all the things that he was talking about before in explaining how the call options work, none of those things are things you're doing while that's happening.
You know,
So,
uh,
Carl wants to go to the calculator. Is that,
we've
do
been,
you,
we've been
you have
trying to go to
something
the
to say?
calculator for the last few minutes, right? No, go ahead. We can go to
No.
calculator. I just want to
Okay.
make sure that I just think that you bring up a very, very valid point around just not missing the message, because I think that's easy to do. Our goal is to help you take control, and all I'm trying to share with you is there's a reason why these strategies work. And it's because the institutions that you're getting these vehicles from are using that strategy on you. Like I'm not sharing something with you that I invented. What I'm sharing with you is leverage is about arbitrage. You're using money at a low interest rate, making money at a higher interest rate, and you get to keep the difference. If you take that arbitrage approach to the rest of your life, where can you have an arbitrage created situation such that you're able to build more income, generate wealth, and do other things with it? Why? Because every time you go into Bank of America and every product you get in Bank of America, they are treating you as an opportunity for arbitrage.
Yeah,
Let's
every
go to
time you say
calculator.
that word, I think of a bird. What is the bird name? Albatross.
Albatross. Arbitrage.
Yeah, think of that
Arbitrage.
bird. Okay, ready to go to
Yeah.
the calculator now?
What's the example?
Um, well, hold on so that it's all together like a little package. I'm trying to do some magical things over here. Okay, how would we do this one? I don't know actually if this is going to work. I don't know. I can't see it. I don't know if this is going to work. Hold on. Dang it. No, I wanted to do a cool thing. Hold on.
Yeah, it said you're on stage and then it didn't.
I don't know. I wanted to do a cool thing. Let me, forget it. I'll do it next time. Okay, go
No
ahead.
worries.
Okay, so here's this here's the deets, okay? All right, I'm going to show them up here because it's a lot of words. All right.
Uh,
Mr. W wants to invest 5K for 20. I feel like this is like Johnny has five apples. Okay, ready? Mr. W wants to invest 5K for 25 years for his 15-year-old granddaughter. That's the
and
first one.
is that 15 a year or 15 one time?
No, 15-year-old granddaughter.
I'm sorry, is that 5K a year or 5K one time?
5K for 25 years.
Okay. 25 years would be
Okay,
34.
so I think Carl, party of one, can you come and clarify this? Okay, so let's just do that one first.
Okay, no problem.
Good?
Yeah.
And if he needs to, then so we have like four
So we're talking
scenarios.
about $417 a month. So 15 for you said 25 years. I think that's 20. So that's wrong. 25 years would be 40. So $417 a month is $5,000 a year for the next 25 years, and we're talking about an asset worth about $52,000, um, with liquid cash value of almost a half a million. So this is 52,000 tax free. And couple things here. If you are the one owning the policy on the 15-year-old, you are the one that's able to achieve this $52,000. And if the thought process is at age 40, I'm going to then pass this on to whoever this individual is, all they have to do is continue that same $420 a month payment. And what that means is by age 50, they could be retired. So all because you made the decision at age 15 to put away $500 a month, put this young lady in a position to be able to retire by age, by age, I think I said 50, right? Yeah, by age 50 at $123,000 tax free for life. They've got about 1.2 million. You originally bought a death benefit of 255,000, but as long as they are still here and kicking, we're talking about a $2.2 million death benefit payout. What you've just done is you've created generational wealth all off putting away $420, $416, $417 a month for the next 25 years. You have now placed your this is your legacy, meaning if something were to happen to her at whatever that age would be, there's a $2.2 million payout for the rest of her legacy. And again, if done right, if structured right, all we're doing from this point forward is buying policies on individuals within your legacy, within your family, and rinse and repeat. So
Okay.
instead of the Burr method, it's the SCIA method. Go ahead.
All right. If anybody else wants their numbers ran, put it in the comments too. If you did the same thing 25 years, so age 40, and then you do now it's 5K a year plus 700 monthly. So I think you just would add 700 to that monthly amount, right?
Yep. So we're talking 11, 16. So the same 15-year-old.
Yep.
So yep, 11, 17. Till age, go back to till age 40. So another 25 years. So we're talking $140,000 tax free for life. Now here's what I know about that number 11, 17. That 15-year-old has a max insurability. And that 15-year-old's max insurability is based off her parents' life insurance. And so, and what that ultimately means is, can you get $1,100 a month, into a policy for your 15-year-old? Highly unlikely. The max would be right around $500,000 of life insurance, and we are over. Notice at 1117, that's 683,000. So it's $183,000 over what the maximum amount of insurability would be for a 15-year-old. So what we would do is if we reduce this number down to where it would actually be 1,500, it might be 1,000. Let me see here. It might be 1,000. Nope, still too high. So we're talking maybe 833 or something like that. Let's go to 800. Yeah, so a little bit over 800. So, but still, that's not bad. $800 a month over that 15-year period. We're still talking about 99,000 tax-free in income. We're still talking about almost a millionaire as far as cash value, and we've purchased about 489,000 in death benefits. So that 500,000, we're right. We're close. So somewhere around this dollar amount is about that max insurability that you would be able to do for a 15-year-old.
Okay, did you say, because I was reading some stuff, did you say that she could requalify when she gets older?
Yeah, absolutely. But still, the initial dollar amount, the initial amount of life insurance can't exceed that. So initially at age 15, 800 or around 800 would be the max. And you're right, at 21, then we can, redo this and make that dollar amount what it needs to be based off our age and max it out and do all of those things. But I'm just saying initially you would not be able to get 11, 17 into the policy. But that's okay too. So what you do is you spread it out to others. Maybe you add it to yourself, add it to your wife, add it to another child. So.
Yeah. Okay, Carl's got another scenario. It's 63-year-old male wants a policy on himself with a 40K lump sum, 1,800 monthly for 18 years. Please show the result. Thanks.
18 would be 71, I think. Is that right? That doesn't look right. No, 18 is not 71. 81.
I'm going to let you have that.
$40,000 lump sum, and my assumption is he would want that $40,000 in at one time, and this calculator again splits that lump sum in half, so I can't show it in the calculator that way, but I can simulate something to kind of get close. And it was for $1,800 a month, so I just need to add one to that. So we're talking right around $76,000, 76,808 in income. We're talking about a liquid cash value of about $800,000. You would have put in 428. You would have leveraged about 907, creating a liquid cash value of about 800,000, producing about 76,000 in tax-free income. You would have purchased a death benefit. You would purchase life insurance around 540. If you were to, make it beyond that 80 years of age or whatnot, you'd be passing on to your beneficiaries a death benefit of about 1.6 million. This is a pretty solid approach here. And again, let me show you something though. This is 76,000 based off splitting this 40 grand. The only way I can simulate this is this way. I'm going to put 80 grand. And let's just take a look. 80 grand is 96,000. 40 grand is 76,000. 96,000, 86,000. So if we put all 40 grand in at year one, 76,000 to 96,000, halfway in between that, it's 86,000. So in essence, this number would look like 86,000 if we were to put this $40,000 all in at year one. But because we have to split it up across 2 years, it makes it look this way. So I can build it that way for you. I just can't simulate it in this calculator. So the moral of the story is that income would look more like 86,000 versus 76.
All right. Well, looks like we are ready to move on. So
Let's do it. We can. I don't know about you, but I think the message has been sent. Today was about leverage. The opportunity to be able to leverage a secure compound interest account, using the growth, using other people's money in the form of the participating loan coming from the life insurance company, or whether it's about using leverage inside of using a first position or a second position HELOC to be able to hit your goal. It's all about leverage. And none of that matters though if the cash flow isn't there. This is very, very critical around, this strategy is very, very critical as it relates to understanding or making sure that there's enough cash flow there to be able to sustain what it is you're looking for. So we can end it like this. It's about paying yourself first, starting today, putting your money somewhere secure, compounding your money. And then once you compound your money, using other people's money to be able to produce uninterrupted compound interest. This is not the only vehicle that can do that. It's just a pretty strong one. There are other vehicles that will hit all 5 of those buckets. But most of those other vehicles out there take work. This is one where you actually get to sleep well at night, knowing your money is making money for you. And hopefully, as I showed you earlier, even in a down market, this product still outperforms. And I think that's pretty powerful as well.
yeah. Well, and the time. The time is the most valuable piece out of this because this is not get rich quick. This is not crypto, culture. This is not, you have to learn a whole new industry like some of these other ones are, including real estate, right? You have to learn where your opportunities are. And as long as you understand where your leverage is, and then you start to assess your opportunities, sometimes you go, that's not worth my time. I know that I can do something that will perform better, that does not have the risk, and it's my time. And on that note, we know that time is the most valuable asset that we have, and we are so honored that you're spending your time here with us tonight. So we just want to thank everyone for watching. Share this out, bring somebody else with you so that they can join the conversation too. We have more resources that explain all of the things that we talked about tonight, specifically a secure compound interest account, or just the concept of like, where's this thing been and why is it now a solution? Like, why haven't I heard of it before? All of that is broken down in 2 free books that you can grab right now. We also have, what else is in there? Video series. There's a webinar that explains it all. But the video series is chopped down into little snack-sized portions that just cover each section. So if there's like a question in particular that you had, you can go right to that section and not have to watch, the whole thing. So that's kind of nice that it's broken up like that. There's a ton of free resources in there. Of course, we got the free Velocity Banking worksheet and the Chat GPT prompt. If you're into that, you don't have to use it, but if you're into it, Donnell's like, what the heck is that thing? It's like the third wheel in our relationship now. Cause I'm like, hey, me and Chat GPT, this is what we decided today. And he's like, whatever, I'm not into it. That's fine. I like it. So that's, I know a lot of other people do, and they want to be able to utilize it. So that's there. We're going to show you in just a moment exactly how to gain access to all of that. It's completely free, and we mean it. So we're not here to gatekeep information. We're not here to upsell. We're not here to what would they somebody else say, a bait and switch, or I'm waiting for the pitch. That's what they said. I'm waiting for the pitch. This is it. Go get the free resources, bring somebody else so that we can all level up together. And there's no pitch. It's something
educated.
has to change.
Get
Yeah.
educated.
We have to start educating not only ourselves but our kids. Sometimes we have to educate our parents, right? Because we have to change how these stories are ending. And the only way that we're going to do that is that we learn and we get educated so that we can make confident decisions and that we know what we're talking about and that there aren't people out there preying upon us. So we just decided that that's a service that we can provide. We built a machine that feeds itself, and now we can get out here and teach other people how to do the same thing. So on that note, you want to say something? No? Okay. Oh, we have some comments. Hold on. Dang, we were like right here. Okay, Gary says, I know, and I now understand more about the insurable interest. When it comes to grandchildren and the max amount being based on the parents, but what if they do not have a life insurance policy themselves? That's a great question.
That's a great question. Because I have several clients who have fit in this criteria. Grandparents can insure their grandkids even if the parents don't have any insurance, but the max insurability still exists around the $500,000. So I've seen that. Now, parents, this is weird. Parents cannot insure their own kids if they don't have insurance first. So it's very, very strange. But when you kind of peel back the layers, it kind of makes sense. And here's the way the correlation I try to make. It's no different than being on a plane and the plane is going down. Who do you put the oxygen mask on first? You put it on yourself before you put it on your kids. So grandparents can insure their grandchildren without the parents having anything, but parents have to insure themselves first. And you also have to look at it from the perspective of the life insurance company. It looks strange to the life insurance company if you're trying to insure your children, because what are we insuring? We're insuring their life. It looks strange if you're trying to insure your child before you insure you. What you're saying, are you saying like, hey, I'm expecting something to happen to my child?
Brought you in this world, I'll take you out.
Right. So the message that you're sending to the life insurance company is your child's life is more valuable than your own, when it would make more sense that you put this life insurance on yourself, because who's going to benefit from it if you're no longer here? Your child is going to be the one who benefits. Now, if you're not insurable, for whatever those reasons might be, then okay, you absolutely can get policies on your children, but you have to kind of insure yourself first.
Yeah, Karen's getting the book. She's got the book. She's getting the sheets. She's getting self-directed. And we love that. Okay, April says, last thing, what are the other buckets? She was like, okay, I was good, but now what are the other buckets? I think she just she joined a little later. So would you mind pulling that back up really quick and walking them through all 5 of the buckets? Or all five strategies. Yeah.
Just wanted to make sure that we were talking the same language. Absolutely.
Yeah. All right.
I'll pull it up. So moral of the story is this. And what you're seeing on your screen isn't like I'll call it a prescription. What you're seeing on your screen is how we were able to achieve, or how we're achieving our WTF moment. And basically, this is the combination that we use to be able to achieve wealth, have control over our time, and put ourselves in a position where we can create true freedom, which means be able to do what we want, when we want, with who we want. And it started with this: creating a self-directed retirement account, which allowed me to be able to leverage my previous employer's IRA and 401k, put myself in a position where I could invest that IRA or 401k outside of the market, so it's not subject to market volatility. Our self-directed 401k is actually has an apartment complex and a couple of pre-IPOs and a couple self-storage facilities is what it's investing in. And so it's growing outside the market, which allows us to overcome the 4% rule. But in addition, it allows us to leverage it. And if we needed to leverage it to put ourselves in a better financial position, we could do so. Leverage meaning we can borrow against it. No different than you can borrow against your company, the 401k you have with your current employer. So, but putting ourselves in a position to self-direct a traditional retirement account allowed us to then use velocity banking and infinite banking to be able to put us in a much more positive cash flow position, which in turn positive cash flow position, put us in a much more credit worthiness position, which allowed us to then get a first position HELOC in place of our mortgage, and then use our home as a tool to take equity out of our home on a yearly basis to build our secure compound interest account. And so, what's happening is we're using that equity from that first position HELOC and dumping dumping a fair amount of that equity into a secure compound interest account, which allows us to produce secure uninterrupted compound interest over time. The goal is not to pay off the house. The goal is to use the home as a tool to build wealth. And these are the strategies that we use to be able to get to where we are. These are not the only strategies available. This is not a one size fits all. The thought process was to come on here and just share with you, these are it. You may have others. As a matter of fact, I'm in the midst of adding another one, which are annuities. Those of you who have previous employers' plans, this requires action. Not everyone who has a previous IRA or 401k wants to get involved in real estate, wants to take action with their self-directed retirement account. Well, there's some awesome annuities out there that if you take your previous employer's plans and put it in those, you can remove the market volatility and put yourself in a position to be able to create secure wealth, a lifetime of income going forward. So there are many, again, these are not the only answers. These just happens to be the answers that I know. And I am walking you through what it is I know because this is what we're actually doing. So those are the 5 strategies.
Okay, so last one here. It makes more sense for me to start the MPI than pay off my houses. I get this because, like you said, cash will be king, not equity. And I like what you say because you say you bring your to Best Buy and I'll bring my equity, right?
Right. And again, equity. So all I'm doing is putting you in a position or walking you through how to position yourself the same way banks are positioned. I'm not doing anything other than what we've been conditioned or what we've been used as, and we've been leveraged forever. Banks leverage us, life insurance companies leverage us, financial institutions leverage us. And so the whole thought process is, what if most people will do this? They will pillage their income, they will pillage their retirement to fund their house. But what if we just step back and said, wait a minute, my house is an asset. Matter of fact, my house is the largest asset I have. And if I just reposition my asset, why couldn't my house fund my retirement? Why couldn't my income fund my retirement? So it's all we're doing is redirecting. Instead of using those resources to fund your home, let's pivot and shift your income and your home to fund your retirement. And retirement is not an age. Retirement is a decision. It could be 30, it could be 40, it could be 50. It does not have to be 59. It does not have to be 65. It does not have to be 72. Why? These vehicles that we're using are tax-free vehicles that you can take income at any point. There's no one telling you what that age is. So it is absolutely kind of adjusting how we're used to doing things and just putting that effort in a different direction, focusing on producing income as opposed to focus on producing equity or focus on putting money in a vehicle that we can't leverage while we're in it. That's all.
Being off mute would be helpful. On that note, so we want to thank everyone. Our mantra has shifted from just getting self-directed to a bigger vision in helping people create generational wealth, understanding the power in these strategies, and that not only can you strategize with, sometimes the majority of us have a mess that we have to clean up first, right? But knowing now, if we can get a handle on these strategies, what we could teach our kids and our grandkids so that they are in a completely different position. Don't leave them out while you're learning. Don't wait until you've learned it and you've implemented and you've done it to bring them along. That was something that we had started doing in the beginning, and we realized like we can't wait. We can't wait till they're interested. We can't wait until we have it all figured out. They have to learn with us because time is the most valuable asset that we all have. So on that note, we believe if you don't come from a wealthy family,
You can make sure a wealthy family comes from you.
so stay focused,
Stay protected.
stay tuned.
Stay connected.
I'm Angelique,
And I'm Donnell.
and our job is our goal is to help you get.
Self-directed.
Oh, you're
Have a
not
good
going to
evening.
sing it this time? All right. Thanks, guys. Hold on, and I'll tell you exactly how to get those free resources.
I've been yelling too much. My voice is, so I couldn't sing.
Hey, before you go, we want to remind you that becoming fully self-directed means gaining complete control over your wealth, time, and freedom. It's not just an idea. It's a framework, a mindset, and the power to make informed decisions to secure your future. Being here means you're taking those steps, and we want to thank you for allowing us to guide you. We believe that we grow farther and faster when we grow together. So tune in next time and tell a friend to tell a friend. We've helped thousands of people just like you start their journey to financial freedom. And if they can do it, you can too. And if you're ready to learn more, we got you. Get a head start by grabbing these 2 free books. But how do they get them, Donnell?
Head over to my website where you'll have access to a few things. A ton of free resources, case studies, and over 100 5-star reviews from people just like you. And in 15 minutes, we can explore what's possible for you. So don't wait.
Invest in what you want, when you want.
But first, let us help you
Get self-directed.